Hello everyone. Assalamu alaikum. I am Ashraf Hossain. I am a final level student or advanced level student of Chartered Accountancy under the Institute of Chartered Accountants of Bangladesh, which is ICAEW, that has affiliation and follows the same study materials as the Institute of Chartered Accountants of England and Wales, that is ICAEW. And my remaining introduction would be found in the description box of this video. So I'm making these videos for the students of ICAB, the students of ICAEW, the students of ICAI or the Chartered Accountancy Body of India, the Chartered Accountancy students of Pakistan, the ACCA students, or whoever would need guidelines on these topics, the hedgings and derivatives, including the futures, forwards, options. Of course, we're talking about the commodity futures, the commodity options, the currency futures and the currency options, the index futures, and the money market hedging. We would be discussing all of these in detail, and the lectures would be in English. Yes, in some places I would provide additional explanation in Bengali if needed. But those who are English speakers, please don't worry about those parts, as those parts would already be spoken about in English before I talk in Bengali if needed. So mostly the lectures would be in English. So that's it. Let's start. We are going to learn about the index futures. So what is the index futures? As you can see from here, these can be used to protect against falls in the value of portfolio of shares. Those are of real importance to companies with significant investments, such as pension funds. So these are the futures which are basically used to protect you against the fall in the stock market or in the pension funds or bonds market, any sort of stocks which is volatile in terms of prices. You can be protected by these derivatives. Traded futures are available based on FTSE 100 share index. The transaction costs of investing in these futures are much less than the cost of actually selling and buying shares. Use of futures is an alternative to adjusting the shares portfolio, which may not be appealing. So whatever, the basic thing is these index futures are available in terms of FTSE 100 share index in most of the standardized and developed stock markets in the world. So what we have learned so far, we have learned that index futures are used to hedge against the risk of my shares prices falling. So if there is a market fall, I can be saved from that if I have invested in index futures. Now, how does that work? We are going to learn from the next worked example. The worked example states that the investment manager of Moonstar Pension Funds is concerned that the share prices will fall over the next month and wishes to hedge against these using FTSE stock index futures. The fund's pension portfolio comprises investments which we have a market value of USD 5 million on 1st June 2023 or whatever. So the picture on 1st June is, I have a portfolio, and let me call it share. Value of that portfolio on 1st June is 5 million USD. My fear or my risk is price will go down in 1 month. I've already made this investment and I want to hold it, but I have a fear or a risk the price will go down in 1 month. So what I need, my need is the opportunity to sell when prices go down. Suppose the price of my share was $100 and I have a fear that the price would go down severely. So what I need an opportunity to sell when the price would go down. At least I need $90. If I can get $90, I'm pretty much safe. But suppose there is a situation when the price went to $70 and I don't have these options, then I'm ruined. So I need to be safe from this option. $70 or lower, the price can go down even lower. So I need this kind of hedging, and FTSE 100 index would provide me this. Let's proceed. On 1st June 2023, whatever, the following prices are observed. The prevailing value, that is the spot value of the FTSE 100 index, is 5,000 points. So on 1st June, the index futures, the price of those futures is 5,000 points, because the futures are measured at points and each point values for $10. So 5,000 points would mean what did I do? 5,000 points would mean $50,000. So we have a picture that on 1st June, the spot price of FTSE 100 index is 5,000 points. The code for September FTSE 100 index is 4980, which is, there is a typo here. It would be June. The code for 30 June FTSE 100 index. So you should edit this one by 30 June. This would be the code for 30 June FTSE 100 index. Future is 4980. What does this mean? Today, on 1st June, as I'm writing here, the price of FTSE 100 index is 5,000 points, which is $50,000. You've shown this. Now there is a code for 30 June for 4980 points. It means that, as I said before, I need to sell after 1 month. That is, on 30 June, I need to sell at a certain price. Now today, if I want to take this FTSE 100 index to hedge, they would give me an opportunity to sell this FTSE 100 index at the end of the June, that is on 30 June, for 4980 points, that is 49,800 USD. Now don't get confused with the spot price. The spot price is the price of 1st June. Today I don't need this FTSE 100 index because I want to hold my investment now, my share now. I don't need to hedge on 1st June. I need the hedging on 30th June, when I am predicting that the market would fall in 1 month. So I need the FTSE 100 index to provide me the hedging on 30th June, right? And for this, I need to do the contract on 1st June. If I do the contract on 1st June, it would give me the opportunity to sell that contract on 30th June for 4980 points. As we have already mentioned, the face value of each FTSE 100 index contract is USD $10 per index point. I've already explained that. Now, using the futures price of FTSE 100 index, this gives a contract value of 49,800 USD. We have already explained that too. So now, what would happen to us? First, we need to calculate the number of contracts we need here. For the number of contracts, the formula is market value of the portfolio divided by value of one contract. Market value of the portfolio would be the market value of our share. We've already written that this is 5 million. And we are going to divide this by the value of one contract, which we have already shown that the value of one contract today is 4980 points or $49,800. So the number of contract, if you divide this would be 100.4, and we need to round this up. And this is a rule of the futures, that we need to round the contract. So the round of value, we need 100 contracts. Now we are going to assess what's going to happen on 30 June. First, let's assume that how index futures provide a hedge if the market falls on 30 June. So our fear came to truth, the market indeed fell off. So how the derivative provided us safety from this. On 30 June, the market value of the shares in the portfolio was $4.8 million. So on 30 June, what happened? The value of my portfolio fell to 4.8 million. The FTSE 100 index and the futures index both stood at 4,800 on that date. Now listen. On 1st June, we had a price of 5,000 points, right? This price was the spot price, right? This was the actual price of FTSE 100 on 1st June. So that is why this is the spot price. So what is this? This is the assumed price or the contract price. As the FTSE market assumed that on 30 June, the price of a future contract, the index future contract would be 4980. So they set the price on 1st June that if you want to buy a 30 June future, you need to, you'd have to, that means the 30 June future gives you a right to sell for 4980. So this is not the spot price. This is the assumed price or contract price. This one gives you a right to sell on 30 June for 4980 USD. And on 30 June, the actual price of the FTSE 100 index stood at $4,800. This is again the spot price for 30 June. So please do not get confused between all these three prices. The 5,000, this is the price on 1st June, the spot price, the actual price. The 4980, this is the price at 1st June, giving you the right to sell this future on 30 June. So this is not spot price, this is the price of the contract. This will give you the right and obligation to sell this future on 30 June for 4980. And on 30 June, the spot price or the actual price of a future in the market is 4800. Now as we have all the prices, what happens? First of all, we have suffered a loss here. We had our share was worth 5 million. Now it's worth 4.8 million. So we have suffered a loss of 0.2 million. This is the loss in the portfolio or share market. And this is the FTSE 100 market. So in the share market, we suffered a loss of 0.2 million. And in the FTSE 100 market, now I have already got a right to sell these futures for 4980. Whereas the price on 30 June is 4,800 points. So what I would do is, as the spot price is 4,800 pounds, I would go to the FTSE 100 market and buy these futures for 4,800 points. Look, on 1st June, when I signed this contract, I did not buy anything. I just signed a contract that I would have a right and obligation to buy on to sell on 30 June, as I needed to sell. Why I needed to sell? Because my fear is the price will go down, and when the price go down, you cannot sell because the price is too low for your share. So as my fear, always remember, when your fear is that you have already invested and the price will go down, you will need to sell at a future date. And when your fear is the prices will go up, you need the right to buy. For example, if today you assume that you have an apple, today you have an apple, and the apple is worth 10 taka, and you're going to hold that apple, you're not going to eat that apple. After 30 days, you assume that the price of this apple will go down to $6. The apple today, the price of the apple is $10, and you're assuming that after 1 month the price would be $6, and you're holding that apple, you're not eating that apple. So you need to sell the apple after 30 days, but your fear is that the price would be $6. So the index future would provide you that you can really, at the end, sell that apple for probably $8. So you compensate some sort of risk, some of those risks. Now, suppose today you have nothing, but you know that after 30 days you'll need an apple, right? You'll need an apple. But your fear is, on today's market, the apple is $10, but you don't need it today. You'll need it after 30 days, and then your fear is the price would be $20. So the futures market, the index future would provide you some sort of a deal that would probably allow you to buy that apple for $15. So somewhat reducing the risk. This is what the whole thing is. Now, I'm going to go to this FTSE 100 market on 30 June, and I'm going to buy this FTSE 100 index for 4,800 points. And as I already have the right to sell for 4,980 points, I'm going to sell it for 4,980 points. So my total gain in this futures market would be 4,980 minus 4,800 into $10 for each points, and 100 contracts. As I've already said that I need 100 contracts for this kind of investment. So the total gain I made in the futures market is $1,80,000, whereas my loss in the share market was $2 lakh. So I suffered a loss of overall $20,000. So think, if I hadn't hedged it, if I hadn't brought the futures contract, my loss in the share market would be 2 lakh, and that would be it. But since I hedged against that loss in the futures market, I could reduce my loss to $20,000. This is the impact of these derivatives. Now you could ask that why couldn't I really hedge the full risk? The loss should be zero. The purpose of hedging should be the loss should be zero. I suffer a loss of 2 lakh in the share market. I should be able to compensate the loss in the futures market. Now there are two reasons. First of all, this one, the basis risk. What is the basis risk? The basis risk is the price of a futures contract may be different from the spot price on a given date. That means the basis risk is the difference between the spot price and the futures price. Let me go back to the example. Here you can see that, note that the hedge is less than 100% efficient because of the basis risk. That is, on 1st June, FTSE index value and the future prices are different, and the rounding off of the number of contracts. If you look at the question, on 1st June, the spot price was 5,000 points, and the quoted price, that means the futures price, was 4,980 points because of this difference. And also, as we had a number of contract of
100.4, but we need to round this up. So due to these problems, the hedge is not 100% efficient. When the hedge is 100% efficient, then the whole loss would have been compensated. But as we can see, the hedge is not 100% efficient. It could provide us shield against $180,000 loss, but we still had to incur a loss of $20,000. Now, what would happen if the market had risen instead of falling down? Assume that on 30 June, the market value of our shares went to 5.1 million instead of 0.2 million. So we would get a gain in the share market of 0.1 million. But what happened that as the FTSE index market is related to the share market, as the FTSE index are for those share market to hedge against the fall or rise in the share market, the FTSE 100 index price on 30 June was 5,100 points. Now what happened is you already have the right and obligation, the futures. The futures not only gives you the right, but you're also obligated to exercise those futures. You signed the contract on 1st June, so you must sell it now. So what happens? As the spot price is 5,100, so you need to buy those futures for 5,100 points from the market, and as you're obligated to sell something you bought for 5,100, you need to sell them for only 4,980. As the futures are obligatory, these are not optional. For those we have options, which we'll discuss later. The futures are obligatory, so you must sell them. So you suffer a loss in the futures market of 1,20,000. So the overall loss is how much? Gain of 1 lakh in the port share market and loss of 1,20,000 in the futures market. So the overall loss is again $20,000. So the good side of futures is, doesn't matter if the market goes up or down, you know that you won't lose more than a certain amount of money. So you have minimum risk, you have minimized your risk. And the downside of futures is, it's obligatory, there is no option of zero loss. If the market rises, you still need to exercise the future.
So this would conclude today's lecture. But of course, we will continue this topic in the next lectures and eventually cover the whole scope of the whole thing, hedging derivatives, including futures, forwards, options, and money market hedging. We'll do all of these with mathematical examples. So if you like the video, consider subscribing my channel. And also in the description, you'd find the link of my Facebook group, the Facebook page. So please follow those networks and share the video. That's very important. Thank you very much. See you soon.